Welcome to this week's review. I'm not going to spend too much time on the trades because there was only one. I want to focus in this review on taking you guys through the most important changes to my six-figure plan, given that I have officially completed phase two of the trade building protocol. And then, we'll just go through what's next. So one trade taken, pound NZD short, trade recap drops on Sunday, excuse me, on the Daily Nugget. So check that out. I go through that position in quite a bit of detail. That was obviously the last position taken before I revised the plan. It was low risk, it met the plan. And so what did I learn this week? I think it kind of clicked that when you understand why you're taking losses or why a trade worked out, you really begin to feel nothing toward the outcome. And it's kind of you're in this mechanical flow of developing this understanding of the sequence of your results based on, a clear sort of plan that you followed. And so regardless of the outcome, you know that over the long run, you should be profitable or, if you're still slightly unprofitable, it's more the clarity. Hence, clarity precedes mastery. And this week was, based on the pairs that I had on watch, which were pound NZD, euro pound, NZD CAD, and AUD CAD. Not much movement, and even when they did move, didn't get really good entries. So sitting on your hands when the market is unclear was quite important and saved me from taking some low quality positions. So what is the most important thing I need to work on improving this week? Familiarizing myself with my revised six-figure plan, just because there's quite a few changes throughout the plan, and it may be easy to deviate from it. I need to put that sort of front and center this week, just to make sure that I'm implementing the changes and the tweaks so that I can, sort of realize the benefit. And then the most important thing I should continue doing this week is remembering that anything can happen when analyzing positions. This is kind of just extracted from Mark Douglas's Trading the Zone, which I'm currently listening to the audiobook. And that kind of stuck with me this week. And it really helped with understanding and accepting the risk of each position, filtered out a lot of low quality setups that I may have forced had I not been thinking in that frame of mind of anything can actually happen and I shouldn't try to force this position if the trade just isn't there. And I think that's a really important thing I should continue doing. So Alpha Capital account, same start date, same account, same login ID. Currently down about 3.5% on the challenge, the phase two challenge. So we carry on with that. And now coming to the six-figure plan. Same framework, starting in the trading environment, which is really the high time frame sort of framework. I've expanded the markets that I'll be trading. So originally it was just foreign exchange markets. Now it includes commodities and equities. So we'll be including mainly equity indices, not really equities themselves, but your US 30, NAS, DAX, ORS 200. I think there's learning more about sort of intermarket analysis and correlations that exist between markets. And so want to include more of those. So that was an addition. Another addition was the number of pairs to my weekly watch list. I've been feeling like over the past this year, only adding 4 pairs has been a bit limiting, just because of the abundance of opportunities. I think that there are each week. And so I've added an additional 2 pairs to this weekly watch list to increase that to 6 pairs now. So yeah, I'll show you later on. The filtering it has stayed the same. So the number of positions I can execute based on my trade management will remain the same, so that I'm not prone to kind of over trading. But it just increases, I think, the spectrum of opportunities that I'll be considering, which I think will be good for trade frequency. Trade following times, it's the same, but we're going into daylight savings in about a week or so. I think it's the 8th or 9th of March. And so if you do trade specific kill zones, just be mindful of that the London and New York kill zone are going to now shift 1 hour earlier. So yeah, that's a minor difference. High time frame market sentiment. The addition here has been the IPTA data ranges. If you've been following the Daily Nuggets, check that out. But that is a really cool addition that I'm adding to my high time frame filtering. And so on top of looking at the monthly range, how the weekly is aligning also with that range, I'm now also considering which way or which high or low price is likely to mitigate based on that 120-day range. So yeah, we'll be implementing and observing that. And yeah, the rest of the sort of high time frame conditions have pretty much stayed the same. Coming to my trade parameters, this is where a lot of tweaks came into my high and low risk sort of differentiation. And so, yeah, I'll just start off the 1 hour, 15-minute time frames. Obviously, an excellent gauge of the daily trend and building on top of the high time frame overview where the market environment is determined, which ultimately leads to that setup selection. This now focuses on how the market is positioned for upcoming sessions based on the setup I'm trading. That is based on either the 1 hour range or 1 hour EPD or the 15-minute IPTA setup. So optimal alignment, and now I've almost included a high and low risk variation for each of my setups. Before it was pretty standard where it was mainly based on the type of entry, whether it was a 1 hour EPD entry or 15-minute IPTA entry, and sort of just applying the principles to that, which I think kind of constrained it a bit and didn't focus on the individual setups which do have high and lower risk variations. And so with the optimal alignment, pro 4 hour, pro daily setup, so market conditions are impulsive. So in a low risk environment, obviously we're going to have those impulsive conditions, and price should be trading near equilibrium or a shallow premium discount level. So 62%, I'd say, is still fairly shallow given that we've had a deeper retracement and we've now established that primary trend. So that gives confidence that we're impulsive, we're coming from a deeper retracement level, and now we're establishing that trend. And we are either on our way to external range liquidity, or we're still shallow in that EPD range. High risk conditions are when we are in a deeper area of premium or discount, and conditions are still very corrective because we obviously don't have that sponsorship yet. And so that it does carry a high degree of risk. For the resistance setups, this is obviously in line with 4 hour trend, but counts to the daily bias. 4 hour will not be aligned daily, but the entry is still in line. Yeah, that's maybe a duplication that I need to take out. And so in this one, if you recall from this past set of insights, I did mention that conditions can either be impulsive or corrective, depending on the nature of the correction towards the daily EPD. And this will, I think, primarily inform the management style of the position. So obviously, if we're more corrective, I'm going to be more aggressive on that management. And so looking at our high and low risk differentiation, low risk, simple price is still correcting into EPD. So we've established our external range liquidity, and we are now established this external range liquidity, and we are now correcting lower. For example, EPD is, let's say, where this order block starts. So until we mitigate that order block, this whole piece of price there, that would be considered low risk. And then for more of a high risk setup, we've gotten that move in, and now we're obviously in this EPD area, see that being our other point of external range liquidity. And this is where price tends to get more corrective. So that's more higher risk on resistance setups that are betting on a deeper retracement, because we could also just head up from that point. So that is how I differentiate that. On the sniper entry, the counter trend 4-hour pro daily setup. And so low risk conditions will be corrective, as the market should be decelerating before a high time frame reversal. And high risk conditions will be impulsive. Price would have spent minimal time at EPD. So same range, we're coming down, starting to correct. We in EPD, you can see we've got this corrective piece of price. Sniper entry at that point is a bit lower risk, because we've spent some time consolidating and generating that liquidity. Higher risk, high volume into the area, shallow mitigation, and we just try to take the entry same time when price is forming some sort of hard low. More often than not, we're still going to get a bit of a correction before price then commits. So obviously those carry a high degree of risk. And then lastly, pullback rider, pro 4-hour trend, counter daily setup, meaning we're trading corrections. And so ideal conditions for the setup may be impulsive or corrective, similar to the resistance setup, but low risk variation is that price has had a shallow mitigation of EPD and is trading correctively. High risk price is impulsive and trading near external range liquidity. So for example, we're coming down lower here. Let's say we formed an order block in this area. Price taps into EPD, become corrective still. We haven't committed to the upside, but we're starting to potentially form higher highs on the 4-hour. This could still be a correction. We tap into that order block and we could still come lower, even though we've mitigated EPD. On the other end, that's our external range liquidity. We've come down, established that trend, near miss of that high, taking a setup at that point, coming lower, still valid, but we're very close to this high, and we are probably gonna sweep, that point to the upside, and so that carries a high degree of risk, because we don't have to correct deeply here. Conditions are more likely than not impulsive, and so that carries a higher degree of risk. And so my two execution setups are the 1-hour EPD entry and the 15-minute IPDA entry. Lower and high risk alternative for each of these setups are as follows. So low risk, price retraces into that optimal trade entry area. I've now refined this or expanded it rather to the 62% or deeper, below with the 70.5. And mitigates key indicator area, sweeps internal time-based liquidity on the 15-minute time frame. That's a low risk sort of variation. High risk prices, it's a bit it's more of a shallow retracement, so 50%. Mitigates key indicator area, sweeps internal time-based liquidity. So it's simple. 15-minute IPDA entry, fairly similar. Both of them need two sort of points of liquidity generation. The only difference is that once we've mitigated the order block or fair value gap, a low risk variation sees that mean threshold being respected, and a high risk sees that being violated. Both, however, will require a reduced risk entry type, which we'll get into in a bit. So basically, these, remember, are not trading. It's, for example, in the setup, we're looking to go long. We have two clear points of liquidity generation. Only difference is we have our mean threshold here. When price respects that, so it's the midpoint of the key indicator area. When price respects that, high chance that we're going to recapitalize in that area and obviously then displace counter to it. When we violate that mean threshold, we get a deeper mitigation of the key indicator area. Still valid, but again, high chance, or maybe not high, but a higher chance that we're going to violate that key indicator area completely. But so that was, I think, a key difference there. And that was really still in my previous plan. But what I have done here is limited only to the reduced risk entry type, as opposed to the 1 hour EPD entry, where that's not the case. And so, yeah, the following two entry types may be used, as discussed in the daily nuggets. Risk entry, once parameters have been met, price displaces lower, forming a fair value gap or order block. I then place a limit order at the base of the key indicator area, which stops above the high, and then the micro time frame confirmation must also be received. These definitions are the opposite way around. That. So yeah, so that is actually a reduced risk entry, and then this is the risk entry. So the risk entry entry is taken aggressively on the first 15-minute reversal or reversal candle in line with micro time frame confirmation. So this entry type will always be required for 15-minute IPDA entry, I think, because price is actually inherently not trading in the direction of my entry. So I want to see that commitment. With the 1 hour EPD entries, it's probable that I will, it's likely rather that for the higher risk entries, I'll wait for more confirmation. And for low risk entries, I'll then use risk entries, but there may be a combination of two depending on other conditions. So yeah, that is changes. Those are changes pertaining to execution. There are some big changes also with regards to trade management and risk management. This is all the same. This is what I was talking about in terms of maximum daily drawdown. So I have 6 pairs on my watch list, and if all 6, change that, are shaping up for a trading session, then I use my discretion to filter the best 3 setups to execute. That's remained the same, and I think that just limits, obviously, the over trading. So can therefore execute a maximum of 3 trades per trading session and have a maximum daily drawdown of 3 consecutive losses. Scaling, that's fine. Big change here. My targeted risk to reward is 1:2. So my take profit will be set at this fixed R multiple of 2R until I'm 2% in profit. And at that point, I adjust my risk to 1% per trade as well. So once I am 2% in profit, target area of 2R is set, with price weighting applied once this is reached. If you don't know what price weighting is, I've done, I discussed it a bit in the daily nuggets around take profits limiting, obviously the upside. That's obviously been debunked through testing. But yeah, it's just a very aggressive approach to trailing your stop loss. Check out Casper SMC's page if you want to see more about that. So yeah, big change there, because how I usually used to set my TPs is looking at 15-minute, 1 hour, or 4-hour high or low, and then that and also requiring a minimum 1:3 risk to reward. And then obviously once price gets there, that target area, then I apply price weighting. But from all the trades taken that required management on the current 100K challenge, the 2R fixed TP method performed very well over the trades that I've been taking. And I've compared that to my current strategy, my current management strategy, my previous management strategy, 3R strategy, which also did quite well. But in terms of sequence of results, 2R was really good. And so I think this is also a play on wanting to build a buffer, and also a strategy to almost recover drawdown more consistently. Because when you are on drawdown, I think it's important to have sort of fixed take profit areas because you're trying to recover. Because the longer you spend in drawdown, I think the higher the impact on your mental state. And so starting balance, we know we're setting our TPs fixed. We're taking small wins. And then once we get to that 2% and we've built a bit of a buffer, then we're still setting a target of 2R, but we are applying a more dynamic sort of profit-taking strategy. And so that, that sums up the changes in my plan. Super keen to see how these perform. A lot of testing has gone into these changes. Most, if not all of them, have been documented on the Daily Nugget, so check that out. And as always, remember, guys, consistency is the choice you make when you start doing the things you know you should be doing day in and day out.